Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we're back with another weekly video with our friends at Strategas. I'm thrilled to be joined today by Todd Sohn, a technical strategist with the firm. Todd, how are you doing today?
Hey, Ross, great to speak with you again today.
Yeah, it's great to have you back. Well, no shortage of things to talk about either. We had a big sell-off at the beginning of the week that looked like it might be a little more ominous and has since reversed. But I know looking through some of your all's work, the market is still a little narrow. It's a seasonally weaker stretch. So how do you guys see the setup for maybe the near term, the next couple of months at least?
Yeah, we're looking at this as still a trend-driven market, right? And then not a momentum-driven one. If you think about coming off the lows in March 2020, it was all momentum and eventually became trend and momentum. But now, for example, you still have about 90% of stocks above their 200-day average. That's a really great reading for longer-term trends, but there's only about half of the index above their 50-day moving average. So things are getting more selective. I think it's been exhibited by the equal weight S&P, which has yet to break out to a new high. It peaked back in May, while the cap weight version of the S&P, being carried by some of those tech heavyweights, continue to make new highs. So as long as that divergence persists, it's a more selective environment for now. But again, you don't want to get too bearish, so given those underlying trends we were just talking about. And so we would still view any pullback opportunistically through this weaker summer stretch that you mentioned. But again, just not quite a go in and buy everything market that we've seen over the last year. Stay patient for now, as a lot of these names consolidate great runs.
Yeah, and speaking of being selective, some of your all's recent work looking at inflows and outflows, of ETFs and funds as kind of a sentiment indicator. A lot of the cyclical areas that had done so well, kind of at least through Q1, financials, industrials, energy, have really consolidated recently alongside the drop in interest rates. But you note that the flows have really started to reverse, which is kind of a positive indicator in your all's work. So could you talk through, do you still like those cyclical sectors? Are those kind of the areas you'd be looking to buy opportunistically?
Yes, exactly. So when we think about cyclicals and value, the amount of money via ETFs that went into those sectors really right after the election and around the Pfizer vaccine news in early November of last year was record breaking, right? You saw since the election to the end of the first half of this year, about 60 billion into value funds and over 75 billion into cyclical sectors, financials, materials, industrials, energy, right? Record breaking. And even if you shortened up the time frame, the flows were really offsides. And what's going on right now is these names consolidate and pause. And as rates have come in, you're getting a great sentiment unwind. And we look at that as contrarian, right? Especially as these outflows persist. And you're going to want to step into these names as this sentiment unwind happens, right? You may think of a name in the industrial sector. They broke out of a 3-year bear market last year. This is just that pausing period. And so, yes, we do want to be adding, and this sentiment unwind is a needed catalyst for them to help resume higher, right? Folks getting a little bit too nervous about what those sectors for future performance is going to be.
Sure, that makes a lot of sense. And so now that we kind of have, lay of the land of the broad equity market, I am kind of a macro guy, so I want to ask, what's your take on the U.S. dollar? What's happening there? Because it has been up and down throughout this pandemic as sentiment has shifted, and the ramifications for the movements there are far and wide across sectors and how internationals perform and commodity performance. So what do you all see from there for what's really been kind of an interesting stretch over the last 3 or so months there?
Right. Yeah, the dollar is absolutely a wild card here. We wouldn't call it a trend change just yet, from a downtrend to an uptrend. That has not happened in our work, but it has our attention here. You look at some of the levels on the dollar index. 93.50 would mark a short-term breakout with a target closer to 95, 96. And if that actually does manifest itself, it's going to start to impact those cyclical sectors we just spoke about, and perhaps move back into some of the mega cap growth names or even broader tech instead. And so dollar overbought in a mixed trend, I would keep a very close day-to-day assessment on the action here because of the ramifications that you mentioned for how important this asset is. Again, 93.50 is really an important level, and then we can start to look at 95, 96 over the coming months. But again, not a trend change just yet, but one of the high priority charts in our work right now.
Yeah, absolutely. I've heard other people, at Strategas refer to it as probably the most important economic indicator right now. So we'll keep our eye on it closely, and we'll be sure to read your all's work along the way. But I want to thank you for stopping by. I feel like we have a pretty good lay of the land right now. Thanks for talking with us, and yeah, we'll hopefully chat soon.
Great, Ross. Thanks very much for having me.